So you wait for the market to finish a trending phase, then you wait for the market to enter a flag, a consolidation. Here a lot of position building, accumulation, distribution is going on, and we are able to define this pattern here with a trend line. And when the trend line is being broken, this is then often used for position building. So continuation trades are often being taken here, and because flags are used so commonly, that is why often after a breakout you will see a huge flush of momentum. So on the breakout you will often see that a trend is really accelerating and making a big move. And then you can see here the market is entering into a momentum death once again. You can see we are moving here lower, resistance, divergence is coming here. We have a higher low, and then on the breakout here the trend is over. So this is where you then ideally at least want to be out, or at the latest point want to be out when the market is really here breaking out of a structure. So flags are really amazing to trade, and you can also use again a moving average. So this is the 1 hour time frame, but this line, the moving average here, is the moving average from the higher time frame. So we have a little bit of a multi-time frame approach here. And what you want to do is, first of all, you want to trade into the direction of the higher time frame. So if the market is above the moving average, you want to trade long. And you want to trade long at the lowest possible price. And when is the lowest possible price? When the market makes a pullback. So you can see here we have 2 flags that are coming back into the moving average. Especially here, this is the best scenario. You have a flag that is moving into the moving average. It's retesting it. It's not able to break below the moving average. So this is a great example and a great scenario where the buyers are still in control. The sellers were not able to get the price below the moving average. And then on the breakout out of the flag, that is where you see the very big continuation of the trend. So you can use flags with a higher or multi-time frame approach to trade into the trend. Another great continuation pattern is the triangle. In my personal experience, the triangle comes right after the flag, and triangles have a horizontal level at the top. So a triangle here has a resistance that is for now showing the pause of the ongoing trend. So the market is in an uptrend, then the triangle is being established. At the top of the triangle we have the resistance level, and the bottom is really here the most important piece to the puzzle, because the bottom shows us that the market is still making higher lows. So there's a lot of pressure building here in the triangle where the lows are still coming up. So there's a lot of buyers, and every time the market sells off, the buyers are coming in sooner and sooner to drive the price back up. So although the market is defined in the triangle and not making higher highs, it is making higher lows, which is a very important piece. And again, you could choose to trade it with a breakout approach or a pullback approach. Both can work. And this is how it looked afterwards. This was the triangle in the previous uptrend, and on the breakout, this is where the continuation happened. So it's very important, and I've talked about this many times in my past videos, when you see any pattern, whether it's a head and shoulders, a flag, a triangle, the momentum death, whatever it may be, you have to absolutely wait until the market is breaking out of the pattern. Never trade a market inside a pattern. Always wait to get out of it. Inside a pattern, it is very hard to make any money because there's a lot of volatility, there's not a lot of momentum. So the market is fluctuating a lot, but it's not moving a lot. And then it's obviously very hard. Your stops will be easily taken out. It is hard to predict if the market is going up or down. A pattern without a breakout is not strong enough a signal. Anything could happen here basically, but the breakout is really the final piece to the puzzle, and you need to wait out for that. The stochastic cycle trading strategy is also very, very powerful. So what do we have? We are on the 1 hour time frame, but here on the bottom we have the stochastic from the daily time frame. The period is 1433, so the default stochastic, but it's coming from the higher time frame. And the stochastic is often giving us those nice cycles. And what we want to do is we want to wait for the stochastic to cross into a new direction. Ideally, you would like to see, if you're looking for a cross to the upside, you would like to see it happening very close to the bottom, because it shows then that the market is coming from a nice downtrend. And if the market has been downtrending a lot, then there's a good chance that we're also going to see a nice uptrend. So especially in Forex, which is a mean reverting market, what we can often observe is that after a strong downtrend comes a strong uptrend. And that's very, very helpful for us traders. So here we have a bullish cross. So the idea is that we are then looking for buying opportunities. We don't buy just because there's a bullish cross. A bullish cross on the indicator is not enough. We still need to add our price action analysis from the charts on top of that to really build a more robust trading approach. So what do we have in a price action? We have a trend line. We connect 1, 2, 3 highs. And also we have here a nice pattern. And then what we want to do is we want to trade here a breakout. We want to wait for the market to get above the trend line. And you can see when we look here at the high and low structure, we also have an inverse head and shoulder. Left shoulder, head, right shoulder. So we really want to make sure that we get above that. We want to get out of the pattern. Just what I said like 30 seconds ago. We have a pattern, but we need to wait for the pattern to be broken. And then we can go with the momentum. Or we could also wait for a pullback. But we need to get out of the pattern. And this is what happens. The market first breaks the trend line, then also breaks the previous high and retests it. And you can see the stochastic is still giving us the green light, so we are in a bullish scenario. You could also use that to build a position. So you could add, or you could enter your first position on the breakout out of the trend line, and then on the retest above the highs, add to your position, for example. And then we could again use a Fibonacci for trade exit timing. So we draw our Fibonacci from point A here to point B. We have point C at the 50, and then 161 could be our first target here, or even our complete target. And the stochastic from the daily is still giving us the confirmation that we are in a bullish scenario. And then this is what happens afterwards. 161 was hit. The market took a long time to hit 200. So as I said, 200 will sometimes get hit by the market, but very often it takes a lot of time. So usually what I would recommend, especially in the beginning, go for a much more conservative option. Go for a target that is easier hit. You don't have to hold your trades for that long, and that is how you could deal with that. Another example for the stochastic cycle approach, you can see this is the same chart that we have been following on the way up. And here is our first example on the bullish break. We have a